What's going on? All right, so today's video is again spurred by a conversation I had with a young couple, and it was actually really funny because I created an argument. I love when I do that. It's probably bad, but I enjoy it. I do. Anyway, this is concerning charitable contributions. Okay, charitable contributions. Now, a lot of you know that the standard deduction has increased quite a bit this year, and so it's becoming harder and harder to itemize and to take advantage of charitable contributions, right? Many of us give to our churches, which is a great thing, but we're not able to take advantage of those contributions. So what I advise this young couple to do, and I want to make sure you understand, I think she gave $5,000 for the year. He said he gave something like $6,000 for the year. So that's about $11,000 of charitable contributions that they can't do anything with simply because of the new higher standard deduction. So what I suggested they do is, instead of putting their money into the church, is to simply put their money into a brokerage account or a savings account, right? Put the money there, allow it to stay there, right? And then after a couple years, take the money out and then give it to the church, right? If you're giving $11,000 a year, after 3 years, that's $33,000, and that $33,000 will definitely be a taxable deduction for them on their tax return, and they will at least have some taxable benefit from it. The church still gets the money, right? And they get a chance to claim it on their return. But if they're giving, $5,000 a year every year, but not able to file it on their tax return, in my eyes, they're losing. If you do, and it's a technical term for this stuff. It's called contribution lumping, right? And it's simply, like I said, putting the money somewhere else and then contributing all of it all at once, so that you can take advantage of it on your taxes. Now, that's one way of doing it. There is another option, and it's what's called a donor advised fund. I've talked about this before in the past, and donor advised funds are really cool. What they allow you to do is to donate all the money today, right? Write it off as a deduction, and the money doesn't go to the charity until later. So let's go back and talk about this. So either you have the option of contributing $5,000 this year, $5,000 next year, $5,000 next year, and then writing off $15,000 at the end of the third year, right? Or you can do a donor advised fund where you take $15,000 this year, put it into the donor advised fund. Okay, the money is then written off as a charitable deduction. Okay, but the money doesn't go anywhere. It's still there inside the fund. And once it's inside that fund, you can use that money to make more money. Now, you have an option. You can either have that money make money and the money come back to you, or you can have that money make money and that money goes to the charity. It's completely up to you. These are very easy to set up through most brokerage, Fidelity, and the sort. So I want to show you just real quick kind of what makes these things so cool. So this is an IRS website concerning donor advised funds, okay? And this just simply says, generally a donor advised fund is separately identified fund or an account that is maintained and operated by a Section 501c3 organization. Now, understand, guys, I have a nonprofit, so it is very possible that multiple people can start a donor advised fund with me, with my charity, right? And the money will be in the account, and they'll be able to use their money to make more money, and the money will come back to them. And then after a certain period of time, the money then comes to the nonprofit, and the nonprofit does what the nonprofit wants to do with it. Okay, I want to make sure you guys are reading between the lines here. Remember, this is law, so you have to read between the lines. I personally have a charity. Multiple donors can put money into a donor advised fund controlled by my charity. The charity cannot take the money. We cannot touch it, okay, because it's inside the fund. The donors are the ones that tell the donor advised fund what to do with the money. And usually, like I said, that's investments, right? And so that's investing, and that's making money. Again, like I said, this stuff can be managed with investment advisors through companies like Fidelity and Edward Jones and all those type, okay? They will manage the money, and they will use their money to make money. After a specified period of time, then the nonprofit gets the money. Once the nonprofit gets the money, the nonprofit does what it wants to with the money. Wink, wink. All right. So what it says here is see here go. Yeah, once the donor makes the contribution, the organization has legal control over it. However, the donor or donor's representative, okay, that's like I said, TD Ameritrade, Edward Jones, those guys, right, retains advisory privileges with respect to distribution of the funds and the investment of assets in the account. Okay, so again, legally, the nonprofit owns the money, which is why it allows you to deduct it on your tax return. But you or your representative has advisory privileges, which means you get to say what happens with that money. All right. And of course, these things have been used in the past to do, what we call tax evasion, right? So it says the IRS is aware of a number of organizations that appear to have abused the basic concepts underlying donor advised funds. These organizations promoted as donor advised funds appear to be established for the purpose of generating questionable charitable deductions and providing impermissible economic benefits to donors and their families, okay, including tax-sheltered investment income for the donors and management fees for the promoters. So again, I read that to make sure you understand what I'm telling you here, okay? All right. A donor advised fund is a fund that's set up through a charity, all right? Donors are able to put money or property, okay, in these funds and write it off as a charitable deduction right now. Okay, but the money doesn't go anywhere. It's still sitting inside the donor advised fund. The nonprofit owns it, but they can't touch it, nor can they do anything with it. The donors or the donors' representatives are the ones that actually invest the money and use it to make money. The money that money makes, okay, can either come back to the donors, okay, or it can go to the nonprofit. It's completely your choice. All right. Another way of doing this is what's called a charitable remainder trust. We talked about that a little bit, I think, in a video before. Let's see here. Yeah, all right, so let me show you what this looks like. So, charitable remainder trust, okay, and this is coming from Investopedia because this is really just a definition. It just says that it's a tax-exempt, irrevocable trust designed to reduce the taxable income of individuals by first dispersing income to the beneficiaries of the trust for a specified period of time, and then donating the remainder of the trust to the designated charity. Okay, what that means is that this trust is set up simply to reduce taxes. Okay, you put the money into the trust. Okay, the money that money makes comes back to the beneficiaries, right? That's whoever you choose, right? It could be you, it could be your kids, it could be your friends, it could be anyone, right? The money goes to them, and then after a certain period of time, the money is then sent to the charity, okay? But it allows you to reduce your taxes right now with your charitable contribution, okay? All right. Now, I did queue up another thing here about how you go about calculating what the contribution is and all this kind of stuff. I'm not gonna go there. But I think you guys got my point. So I wanna go through this again just very quickly. If you're one of those people that you donate to church every year, okay, you're not able to deduct those contributions on your taxes simply because of the new higher standard deduction rate. So what you need to do is take that money, instead of putting it in church, put it into a brokerage account or a savings account, okay, just somewhere where you're not going to touch it, okay. You can even set up a trust. If you don't trust yourself, okay, you can set up a trust where the money goes in there and you're not able to touch it because it's owned by the trust. Now, the trust needs to be someone that you can trust, a family member, a friend. You can also use professional trustees, okay? Your bank is a professional trustee. You can create a trust with them. The money goes into the trust and you can't touch it, okay? And then after a certain period of time, that money then goes to the charity. When that money goes to the charity, then you're able to write it off on your taxes. So again, if you're giving $5,000 this year, $5,000 next year, $5,000 a year after that, that's $5,000 a year. That's $15,000 in 3 years. You're not able to write that money off if you're giving it to the church every year. So give it to the trust or give it to the brokerage or give it to your savings. Let the money stay there. After 3 years, take that money out, put it in church. There's your charitable contribution. You're able to deduct that on your taxes. Okay. Now, if you're in the other boat where you have a lot of money and maybe you're looking for somewhere to make some money, okay, or maybe if you have a lot of money already and you do give to charity, Well, what you can do is instead of giving $5,000 this year, $5,000 next year, $5,000 the year after that, you can take $15,000 right now, put it into a donor advised fund, put it into a charitable trust, and that money will be deductible for you right now today, okay? And then that money can go to the charity later. All right? From me to you, holla.